Hey guys, so today I had been reading this annual report of Pidilite and I found that company pretty interesting because first of all it makes the products which we used in our childhood, fevistick, fevicol, fevicryl, all these products of related to adhesives along with uh, adhesives for adhesives and sealants for construction companies like Dr. Fixit or MSeal. All these products are made by this company and it has a great market share in this domain. So I thought that why not take an example of this company itself? And since we have been learning about balance sheet, the terms used in it, assets, liabilities, and all that, why not take this company as an example to analyze the balance sheets and understand how we can really go about it? So let's just start with it. So as you can see, this is the balance sheet of Pidilite as on 31st March 2016, and this is the consolidated one, and I prefer using the consolidated balance sheet because it includes its subsidiaries also, which indicates a better financial, which is a better indicator of the financial position of the company. Now, as I had told that it's divided into two parts, assets and liabilities, and assets include all the things that the company owns with the intention that they'll generate some cash with those assets, and liabilities just the opposite, that all the things that they owe and they drain cash out of the company. Fine, so let's begin with assets. And in assets, you'll find non-current assets and current assets. Current assets, the assets, as it says, the short-term assets, whereas non-current are the long-term assets. And in non-current assets, the first term you'll see is the fixed assets, and under fixed assets, you'll find tangible assets. Tangible assets will include all the assets which you could touch, feel, like land, machinery, plants, etc. And of course, this number will keep on increasing every year. This is for the 2016, and this is the previous year, that is 2015 financial year. So this will keep on increasing every year because of course a company will want to expand, and for that it will buy new land, new machinery, new plants, right? And because of that their assets will keep growing. So if there's a decrease, of course you need to look into that, what might be the reason, and this is how you proceed. Then coming to the next part, which is intangible assets. Now this is a pretty interesting term in my opinion because look, intangible assets don't really have that much significance when you look at them, but they might be very beneficial for the company as a competitive advantage. Because suppose a pharma company, as I told in the previous video also, a pharma company gets a patent done for a particular medicine or vaccine. Taking an example for COVID itself, Pfizer came out with a vaccine, and suppose that no other company came out with a vaccine. So Pfizer will be the only company who has the knowledge and will be selling the vaccine, and they'll make enormous amount of money through that. And intangible assets will also include the trademarks of a company and other knowledge that the company possesses, and by which they can really generate revenue and gain some competitive advantage. I haven't really found any company in which I would say that intangible assets will give them a particular competitive advantage, but I keep looking forward to it. Anyways, let's move ahead to capital work in progress, a simple term, all the capital that is currently under process as on this date. So that will be coming under capital work in progress, and it's a pretty neglected term. Nothing to look into this, just that there shouldn't be any significant change. So the next term is goodwill on consolidation, and what goodwill and consolidation means is that, take for example, Pidilite is expanded only in North India. Fine. This is a hypothetical example, by the way, where Pidilite is expanded in North India and they want to expand further into South India, let's suppose. So they say that there are already companies running in South India having good brand values. So how will we compete them? Then they say that we can find a small company which has a good brand value, we can directly acquire that company and start our production and sell our products. So what they do, they approach a company, they say that your company, your company's value is 100 crore rupees on paper, according to all the valuations and all, it's 100 crore rupees, but they're ready to give an extra price. Pidilite says instead of 100 crore rupees, we'll give you 150 crore rupees to acquire you because you have a good brand value and there is trust among your customers and all that. Because of that, they pay an extra 50 crore rupees, and this 50 crore rupees goes into goodwill on consolidation. So, in my view, goodwill on consolidation gives you a rough idea about how company is making acquisitions yearly. Now, if this term is increasing, like it's doubling, tripling every year, that is a bad sign, right? Because that means company is making continuous acquisitions, or just dependent on acquisitions, or it may also be possible that they're paying too much as a goodwill for acquiring a company. Now, this may be a bad sign, but it is also possible that because of these acquisitions, the company is also growing. So, you need to look into the management discussion part and figure out that what the company is planning. Have they been successfully acquiring companies? How has been the performance after acquiring? Like, take for example, they acquired in 2016. How did their acquisitions perform in the further years in 2017, 18, 19, so on? So, if you analyze from this point, you'll get a good idea. Now, moving to the next part, which is non-current investments. And what I'll do, I'll just go to this note number 15 to find what these non-current assets investments are. Now, as you can see, they have made some investments in associates. They're basically their subsidiaries, joint ventures, and they have a lot of shares for these companies. Like you can see, original cost of acquisition, including goodwill. All this will come under long-term non. I mean, it will come under non-current investments, and this is the long-term part. Fine. So you can go through this, and they have properly explained and mentioned what are their long-term investments. Then one funny part is that they've also invested in a lot of mutual funds. Now, you may be asking, why is a company like Pidilite, which makes Fevicol and Dr. Fixit products, is investing in mutual funds? But what happens is, look, a company may have made a profit of, say, 100 crore rupees, say 1000 crore rupees, and in that, their plan is to expand by allocating 200 crores or 400 crores rupees of capital. Say 400 crore rupees capital they plan to invest to buy land, then a plant and machineries and all that, and 1000 crore rupees was their profit. Now they have remaining 600 crore rupees. Now either they can keep this 600 crore rupees in bank, or they can efficiently utilize this money to invest in mutual funds and different securities from where they can get a better return. And that's what these companies do. They go and invest in mutual funds, or they invest in FDs, debt funds, and all this. And this is how they proceed. So that's basically what's explained over here, and it's a good thing if it's rising. That means they have made some good investments over the time. Right, then moving on to the deferred tax assets. Now, this is a pretty simple term. Deferred tax assets is basically just the accounting policy difference between the income tax department and the company, and because of that, mm, the company has to pay or get some money in assets. They'll be getting some money in the future because of that difference. So that's just deferred tax assets. Just ensure that this term shouldn't be too high when compared to the revenue, because if that happens, that means, I mean, there shouldn't be much difference in the accounting policies. There can be here and there a bit of difference, but if there's too much difference, you need to look into that. That's a concerning sign for me. Then coming to the next term is long-term loans and advances. A pretty simple term, as you can see. Loans, who doesn't know loans? But the funny part over here is that it comes under assets. And why is it coming under asset? Is because, as I told, that these are not the loans that they take from bank. These are actually the loans that the company gives to its distributors to help them and gain trust, basically. And also the advances that they may have paid, there may be some expenses which the company was going to pay during the year, so they paid it before itself. So that is what is included in this part. Then moving on to other non-current assets. Uh, for this, you can directly go to note number 18 and see what these non-current assets are. And as you can see, they have invested in fixed deposits. They got some benefits from exports and interest from bank deposits, right? So these small things uh, is what they got. And now coming to the important part, which is current assets. The first term it includes is current investments. Similar to non-current investments, they have invested in again different types of mutual funds or something, but for a shorter period of time. So it comes under current investments, as simple as that. Then comes the important part, which is inventories. And look, inventories are basically just the finished products that the company has on this date. And if the inventories are doubling, tripling, maybe even increasing by 10 times, that's an alarming situation, because I can get two three informations from that. First, that the company is not able to sell its products, and because of that their inventories are piling up, which will of course be a burden for the company logistically. Second reason can be that the company does not have a good inventory management system, where they do not manage the demand and supply part effectively, and are not able to calculate how much demand there is in the market, and they are overproducing it. So that's also a way to find that the company is efficient and not technologically driven. But there's another thing that you can infer from here, is that look, if a company wants to expand at a rapid pace, suppose Pidilite is established in India and it wants to expand in some other country, say it wants to go to US and start producing over there. So what they'll do is that they'll try to ramp up their inventories, so that as soon as they enter US, they start selling it over there. And this is what many companies do, and that's why you might see an increase in inventories. That may also be a reason, but this shouldn't continue for more than 2 or 3 years, as far as I believe. But if this is happening, you need to check. The management should mention that, yeah, they're looking for an expansion, and that's why there may be a rise in inventories. All right, then going to the next part, which is trade receivables. And as I had explained that these are basically the money which the company expects from the distributors. So what they say to the distributors, that we'll give you the flexibility that you go and sell our products, and you take 30 days to repay us the money which you get on the finished product. And these are those trade receivables. Again, you shouldn't see that these trade receivables are doubling, tripling over 2 3 years, because that means they are not able to collect much. They're not able to collect money from the distributors, which is of course a bad sign. Along with that, this term, this trade receivables term, shouldn't be a major portion of the revenue, of the total revenue, because that indicates that the company is giving a lot on credit to its distributors and getting less money in return, which of course is a bad sign. So just ensure that. Then coming to the next term, which is cash and cash equivalents, it's pretty simple. So actually, what happens is, the profit that a company makes is not the actual amount of money that the company has. They make some investments here and there, and of course, that's not the actual money that they'll be having. That's just the profit that they have made. The actual cash that they have in their bank accounts with them to easily deploy are the cash and cash equivalents. And I just ensure that
this term should neither be too high or too low compared to its revenue. Because look, if it's too high, that means the company won't get much returns from the cash and cash equivalents by just keeping them in the bank account, right? What do you get? You get at most a 4 or 5% return from a bank account, which is not efficient at all. Rather deploy them for some at some good use, maybe by just investing in mutual funds also. That's also pretty good. But if it's too high, of course it's alarming. Then even if it's too low, that's also a bad sign, because anything can happen. Suddenly the company might need the cash for an emergency, something unexpected might happen. So they should keep a good amount of money with them compared to its revenue again. And that is all you have to ensure over here. Now moving to short term loans and advances. And again, short term loans is similar to the long term loans and advances, just that it's for a shorter period of time. And similar with the other current assets, it's just for a shorter period of time. Now, moving to the equities and liabilities part, we'll first start with the liabilities part, which includes minority interest, and which is in this non-current liabilities. So the first in non-current liabilities is long-term borrowings. Now look, long-term borrowings is a really good sign to check how the company funds its assets. So you can see from here that whatever the company is buying, are they buying by the profits that they generated, or are they borrowing money from the bank and then buying these assets? And that's a really good sign to see how healthy a company is financially. So if this borrowings are high compared to this equity, it's an alarming situation for a company, no doubt about it. Because that means that to buy its assets, the company has to borrow more money rather than uh, they deploy by themselves by using their cash. That means which also indicates that the company is not financially stable to buy assets and keep the business running. So always keep this in check. It's one of the most important parts of the balance sheet. And yeah, one more exercise that I do, a small exercise, is just that what you can do, you take the cash and cash equivalents part from here, which is 1300, and you subtract it from the long term borrowings over here. And if you see a positive sign, a good positive number over here, that will be a positive sign. But if it's a negative number, you have to be careful about the company. Just this is just a small exercise which I follow. uh, I recommend you can also follow this. I learned this from a great investor, Peter Lynch, from his book One Up the Wall Street. By the way, I recommend you to buy and read that book. Anyways, another thing that you can look just in long term borrowings also. You know, these long term borrowings the are not only loans that they take from the bank. They can also borrow from investors like us by issuing bonds. That is something we'll cover after some lectures. But if you know what bonds are, you'll be knowing that they can raise capital from the investors by issuing bonds. And that is a very good way, because on bonds you have to pay relatively less interest to what you have to pay in a loan. And loans are type of a thing that are very compulsory to pay, whereas in bonds you have a little flexibility relatively. So if a company has a lot of debt, a lot of borrowings, but its borrowings are funded by bonds, it's still a good sign. It's at least not a bad sign that you can look for. So yeah, this is one point I wanted to mention specifically, because you can find some turnaround companies by using this. A company which is not performing well but can perform well in the long term. Anyways, moving to the next topic, which is deferred tax liabilities. And again, it's similar to deferred tax assets. It's just that in deferred tax assets, the company benefits, and in deferred tax liabilities, the company will have to spend some money. So it's simple. Again, it shouldn't be too much compared to the revenue. As long as it's less, it's fine. Then coming to the next part, which is other long-term liabilities. So what I'll do, I'll just go to note number 7 and see what this long-term liabilities for the company are. So coming to note number 17, you see that over here also they have mentioned other long-term liabilities. So basically, I get to know nothing from this note. Now this one person might say that, yeah, this is not a good sign because a company is not telling about itself what its liabilities are. But how I infer this is that this is a very insignificant amount for the company, and there is not much need for them to tell about what these liabilities are. So as long as it is low, it's fine. You can see last year it was zero, and this year also it's a very small amount. As long as it doesn't increase too much, and even if it's increasing, if they don't mention, that can be an alarming sign. But in this case, I think it's completely fine, and I think you can go ahead, continue reading this annual report. Then comes long term provisions, and these are basically, so what happens is a company might have some expenditures in the future, and they're pretty sure that we are going to have these expenditures. Or it might happen that there are some uncertainties that something might go wrong, or something might happen. So they keep a provision of money, a certain pool of money, that for this particular thing, we'll be spending this much amount. And that's what they have mentioned over here. And it's fine, this will be increasing over the years, because these long term provisions will include employee benefits. Of course, as the company is growing, the number of employees will grow, and the salary you pay to the employees will grow. So this term you'll generally see a rise, and it's completely fine. Then going to the current liabilities part, the first term you can see is short term borrowings. And irrespective of whether it's high or low, I don't really pay much attention to this term, because look, a company takes short term borrowings with the intention that, yeah, they can easily pay off this term, these borrowings, within 1 year itself. So it doesn't look as a big concern for me, and I kind of neglect it unless and until I see some major change. Alright, then moving to the next part, which is trade payables. Trade payables will include, as I told you, that it's exactly the opposite of trade receivables. So trade payables over here shows micro and small enterprises, and other micro and small enterprises. Basically, again, a normal term, as long as it's not very high compared to the revenues, it's perfectly fine. So yeah, moving to the next part is other current liabilities. And other current liabilities, it's again very similar to other current assets. You can simply go to this note number 11 and find out what these other current liabilities for the company are. And as you can see, they have taken some loans, they have some unclaimed dividends which they might have not been able to pay, and other payables like advance from customers which they have taken, or contracts or trades. All these things, small things, will come under other current liabilities. And then moving to the next part, which is short term provisions. Again, it's similar to long term provisions only, but let's go ahead and check in the notes. So look, they have kept provision for employee benefits. They'll be paying gratuity, compensated absences, anniversary awards, right? All these will be paid to the employees. and they have made a provision for this before only, that हाँ we are in the upcoming year ये हमारा खर्चा होगा, so why not keep a pool of money before as a liability that we are going to spend. So that's what they are mentioning over here, and it's very small amount. And anyways, it's good that they mention about the provisions that they are going to spend in the upcoming years, so nothing to much worry about. Then, coming to the last part of the balance sheet, which is equities. And in equities, the first term is share capital, which is the term I told you that when a company issues an IPO and issues the shares on the exchanges, it raises money from the investors. And that money, the amount of money that they raise from the investors, come under share capital. And that is what is represented over here. Now, one thing that you need to look on in the share capital is that this shouldn't be increasing by a lot, because if the company share capital is increasing, so is that means that again and again they have to depend on their investors to borrow money, and that's not a good sign. That means they are not being able to fund by themselves for their assets. So just see that this term should remain constant or increase by a minor amount every year. But again, this depends on industry to industry. Some industries are there which are very debt intensive and they have to borrow a lot. So you can see the competitors also how they are doing and make your decision comparatively. The least fluctuations there are in the share capital, the better it is for the company. All right, so moving to the next part, which is reserves and surplus. And reserves and surplus you can categorize mainly into two parts, which is reserves and surplus. So as I had told that when a company makes a profit, it pays out some dividends to its shareholders, and the remaining amount that is left comes under reserves and surplus. And from there, if a company, suppose a company plans that in the next 1 to 2 years it has some specific project or some specific plan that it's supposed to do, they allocate some capital for that, and that capital comes under surplus. That means for the amount of reserves that they have, which they allocate for a specific purpose, will come under surplus, and the other will come under general reserves for emergency situations and all. So that is what it is, and what I see is that this term should grow over the years. Of course, that means they'll be able to fund their projects even more nicely and have to depend less on the borrowing part. So this is one important term that I see.
Now, guys, there's one very important thing that I must tell you, and that is that anything about analysis that I'm telling you, do not take it at face value, because look, you might have a different opinion, I might have a different opinion, and that's completely fine. As long as that approach is driven by logic and data, you're good to go. And I'll tell you with the help of an example also. There's a company, Delta Corps, and it's into gambling. It's into the gambling business and all. And as you know, that gambling has a lot of restrictions, a lot of regulations in India, and because of that, it's a risky business. So there are different perspectives. On one side, a person says that यार बहुत रिस्क है, regulations भी बहुत ज़्यादा है, गवर्नमेंट कभी भी आके बंद कर सकती है, it's better to stay away from the business. But on the other hand, a person who's willing to take a little bit more risk, he'll say that यार माना रिस्क है, regulations हैं, but इस रिस्क और रेगुलेशन के वजह से there'll be very less people who will come into this business, and they can create a monopoly in this, and because of this monopoly they can demand more profit margin. So both these people are correct in their approach. There's nothing wrong. Depending upon their risk appetite, they'll take their decision, and that's what I'm trying to tell, that don't limit your opinions just because of my limited knowledge. That doesn't make any sense. Rather, I'll be happy to hear about your opinions as long as they're driven by logic and data. Now, there's just one statement left, and that is the cash flow statement. and I'll tell you why I think that the cash flow statement is better than the profit and loss statement, and I'll see you in the next video. Bye.